You might wonder why the title is actually not the one that is on the slide, on the schedule. Sorry, it's still mostly the same paper, but we just recently decided to change the title because we think we can make a point on this secular stagnation debate. Why we have observed in recent years low growth, declining asset returns, and Summers is one of the major contributors to this discussion. And he brings up several points why in the future there will still be, or there might still be, low growth, low and declining asset returns. And we want to make one particular point here because one of his points is that demographic developments also have a large impact on that. And we want to focus on this point here in this paper. So if we look at demographic forecasts for the US, then we all know that there's a strong process of aging, or a process of strong aging ahead. So comparing year 2010 to year 2030, so the forecasts say about the ratio. What I put up here is the working age population over the total adult population, so-called working age to population ratio. A large drop of about almost 10 percentage points. Put this the other way around, looking at retired population over working age population, we see a large increase of 16 percentage points. So
take a fixed age for the
exactly, yeah. We do take here just the age 20 to 64 for keeping it fixed over time. Even if we increase the age to 67 in 2030 or something in between, then still a large drop of about 6 to 7 percentage points remains. So it's still an issue. So what are the macroeconomic implications of that? As I said, people expect that there's low growth or decrease in capital returns. And why is that? I may want to make the participation
stay the same, right?
Yeah, exactly. I mean, this is really keeping it fixed, just putting out some simple descriptive numbers. And for sure, there can be a lot going on, but I mean, it's really a large drop, so this is the first order effect that we think is still in place.
But this doesn't take into account participation, right?
Yeah, that's what it's just pure demographics, yeah.
Still quite a lot of potential for female participation to go.
There is still a lot of potential, yeah, true. I mean, what we are going to talk about is on the household level, and there's an endogenous choice of human capital, as we put it. So, I mean, the question is always what you would call human capital in these models. So maybe there's also a response within the household in terms of human capital, and you could put this partly to participation, maybe also in the labor market. But we are not particular on this in this model. Okay, I'll come to that in a second.
And does this forecast take into account the same immigration patterns?
It does. No, I mean, this comes from forecasts of demographic researchers, and they have models. I mean, that we take this as exogenous. We don't go into detail on this, but there is immigration in these numbers, and this is like the medium fertility, medium immigration scenario that we put up here. So there are different scenarios that I bring up, but until 2030, I mean, it's really rather a short forecasting horizon. So still, I'm confident that this might, in terms at least in terms of the birth rate, survival probabilities, this might be all right. Just a simplifying calculus to make clear the point with respect to asset returns. So just think about the standard Cobb-Douglas production function, K capital input and L labor input. If you look at the output per capita, and we just assume for a second that capital per capita remains the same, then we see that the drop in the labor per capita of about, as I said, 10 percentage points, 10%, sorry, or 10 percentage points as well, boils down to a decrease of the marginal product of capital of about 7.5%. So I said, I mean, this is really taking capital per capita would remain fixed, just a very simplifying case, and also the quality of labor remaining fixed in participation. But I mean, this is a first order effect, and this is what we want to look at for now. Okay, what we're finally interested in is not output per capita as a cross-sectional measure, but rather about what we're interested in is welfare of different generations in this paper. So finally, what matters for that is how do returns and wages change over time, and this is what we want to investigate in this paper. subsidiary questions are then really the quantitative effects in terms of asset pricing, on the asset returns, on wages, or here we put it human capital returns. And we also split up the asset returns into one period ahead, risk-free and risky assets, because there's a, as we put it, age pattern in the investment of households. So meaning that old households rather drag their assets towards safe bonds. And given that, there's a point that the difference between the difference in the impact of demographic change on the two asset return types, two assets, might matter for the wealth implications of people over time, because the different structure or the different meaning of assets in the early stage of the life and the late stage of the life. Okay, so what we particularly want to show you is what does human capital formation in this respect. So why is this very important? So in terms of here, it's all about the quantity of labor, for sure. Participation is a main issue here as well. But we also want to show what the quality of labor might does to that. Okay, what is our approach? As I said, we take a demographic change here exogenous in terms of changing survivabilities, fertility rates, and also immigration is in there. We put up a quantitative OLG model, large scale, in the tradition of Auerbach and Kotlikoff. So general equilibrium production economy, with aggregate risk and unindividual idiosyncratic earnings risk, and having background risk, meaningful background risk. We do take a risky human capital approach, which comes from Krebs. This is finally allows us to keep computational tractability in this large-scale OLG model. And we do have an endogenous choice of portfolio. As I said, we want to split up the asset returns into risky and risk-free assets. And here we can think about this in terms of equity bonds and human capital that you invest in. Okay, we then predict, as I said, human capital and asset returns, and we want to compute welfare effects finally.
So there's no intergenerational links here.
Sorry?
No intergenerational links here.
Intergenerational links? No, in terms of dynasties or something, no. No, there's not. But it's an OLG model, so there is intergenerational links over the markets, but yeah, I know what you mean.
Wouldn't that kind of matter if you just take demographic change as exogenous? And is that really exogenous to your human capital choice?
I mean, for sure, would be good as a next step to introduce something like intergenerational links. This is for sure. Yeah, I mean, it's always the case. Okay, let me show you our preliminary results. So if we compute the entire transition, starting in 1960 to far reach point in the future, then we can, and what I show you is just the numbers which come out in 2010 versus 2030. So this is the change from 2010 to 2030 in terms of the average human capital return, the risk-free, so the return on risk-free bonds, one period ahead, and on risky stocks. And this is the equity premium, what we define as the difference between the two returns. If you look at the baseline model, then it shows that the effects on the returns, and this is in terms of percentage points, there are negative effects on real asset returns, on asset returns, so declining asset returns, but they are rather limited. We do observe a small increase in the equity premium in terms of as we have more old people in the economy demanding relatively more bonds, leading to less demand of stocks in these terms, and this drives up the equity premium, so there's a small effect on that. However, those effects are rather limited. So what we do on top of that is we show a variant of the model where we try to keep the quality of labor, which is, as I said, an endogenous human capital choice here in the model. We try to keep this fixed artificially and look at what would be the effects in that case. And this is what comes out then. We see a strong drop of about 1 percentage point in the risk-free rate, and also a little less in the risky rate, so the equity premium increases, and an increase in wages, or here in the return on human capital.
Sorry, it's a bit difficult to understand this forecasting. So I guess when you did the quantitative thing, the agent has been happening for a while. So did you run run the model for
Yeah.
the last 20 years or calibrate the parameter to those and then say, oh, we predict these?
Yeah, exactly. So,
Difficult to understand what
okay.
yeah.
Okay, so the transition, demographic transition starts in 1960
Yeah.
with
So
us.
did you run the model for
Exactly, we run the model for that period. So far at this stage, I mean, it's still preliminary, so at this stage we calibrated the model to the year 2010. But, I mean, the next step would be to calibrate it to the transition from 1960 to 2010. This is what I can say so far.
Because most paper would do the past first and then say what might happen.
Okay, see your point? Okay.
So that's 0.08. Is it 8% or 8
No.
points?
No. This is really in percentage points, so it's really almost nothing in this respect.
So isn't it a bit worrisome to take the other numbers seriously if the equity premium is like 100 times smaller than the real one?
Sorry, I didn't get it. That's good.
So in terms of calibration, right, you want to hit certain targets
I know.
so that you can take the others.
Sorry, this is the change. This is the change from 2010 to 2030. So we target an equity premium of about 6.2 percentage points. So this is just a change from 2010. So the effect of demographic change on that number.
So yeah, you said it. So the effects on the equity premium come from what you say is more preference of old people for bonds, right? So I mean, that's standard investment advice, but I just saw last week I saw a paper by Jay Hong and co-authors, and they actually had data where they showed that at least from 20 to 60, actually people go against that advice basically, right? That actually the young guys hold more bonds and the older guys more equity. I don't know what happens for the retirees, right? But that
this is what we
for that or what does?
Yeah, the literature, I mean, is not totally conclusive on that. I mean, at least it is conclusive that in retirement, the share of risky assets in the portfolio declines.
So in
What happens?
too, okay.
Yeah, what happens before that? It's not that clear. I mean, what we put up is really a standard model in this respect, where we have a declining share all over the life cycle, and we can show what comes out here.
When the
And
guys they have a debt model, they probably hold so little of aggregate wealth that probably wouldn't bother you much, I would guess.
for the young guys, that's what you mean.
Yeah,
Yeah,
so
exactly.
20 to 40, they don't hold
This
all the
would be
assets.
my next comment on that. Yeah. Okay. Very fine.
But
Sorry.
then you're not only assuming that demographics is exogenous, you assume also that the social security system is not changing.
Yeah.
What if then can you
Sorry.
make proposals concerning the retirement age, or that will
Exactly. I mean, this is all that we can do about all that we can do about this is really in terms of different scenarios that we run in this model. So we don't have so far we hold the retirement age fixed. The next step will be, we haven't done this yet, the next step will be to look at what happens if we change the retirement age towards 67 or something. So far, and there's not a pension system in this model so far. So this is all next steps that we have to take. Totally sure that this is very important. Okay.
And can you give an intuition for the different results?
Yeah, exactly. So finally, what happens more or less, what I showed in the beginning, so because of the drop of the labor force, the marginal product of capital, first order effect, goes up, the marginal product of labor goes down. The other way around, the marginal product of capital goes down, the marginal product of labor goes up. So wage, this is what we observe here, then in equilibrium as well. So the returns on human capital go up, so this is an incentive for households to invest into human capital. So in this demographic transition, they expect wages to be higher in the future, so they invest into human capital today. This increases their human capital and leads then to an equilibrium to a counterfactual effect. So the quality sorry, I was not clear on this. So the quality of labor in the baseline model increases, as I said, because of this incentive. So this equalizes, or partly, this drop in the labor force that we see from the quantity of labor per se. And this is why effects are much less strong than in this case where we hold the quality of labor fixed, okay? Because here is just the quantity effect on work, and the quantity effect and the quality effect, we see that the quality effect offsets the quantity effect partly. This is finally what it is here. Okay, so what we observe as well is welfare losses for current generations. Why is that? Because current generations suffer from declining returns at their old ages, in particular in terms of the rate to return for risk-free assets. Young future generations gain by this demographic change. Why is that? Because in future they will have higher returns to human capital, and this is what current generations don't have anymore. Okay, this is exactly what drives us mainly here. Okay, yeah, sorry.
If you take the average equity premium in the last 2 decades, you see that it's smaller compared to the previous decades, right?
Yeah.
And this would be in contrast with this, right?
I mean, there are a lot other things going on in terms of the equity premium, and the past change in demographics was not as pronounced, or by far not as pronounced as we expected for the future. But I mean, still, as I said, this is not really, it's really a small effect that we predict here. So still, I mean, there are other factors affecting the equity premium. I wouldn't claim that this is not in line with this.
And this is such an interesting framework, but I think for this question especially, it would be nice to think about open economies, right? So if other countries are on the other side of demographic change, then it's just kept them.
Yeah, in general this is true. I mean, this is calibrated to the US. The US is more or less on the average if we look at the demographic changes in the future all over the world. So this is what how we claim that this is maybe still somehow not too bad what we do. But for sure, I mean, this is always the case that open economies are better. Okay, let me just be quick on this. So what is our contribution to literature? Literature is we are related to this literature which looks at the welfare effects, growth effects of demographic change on one hand side, but also on these asset pricing literature, these asset market meltdown literature saying that, or discussing at least the fact whether or not asset returns plunge when baby boomers retire. Okay, what we do is endogenous asset pricing in this framework. We do split up the asset returns into risky and risk-free assets. We show that the human capital channel is very important in this respect. And we set up a model where we can compute transitional dynamics really in a large scaleology by preserving really computational tractability in this kind of model. Okay, let me guide you quickly through the model. So on the production side, production is with a constant constant returns to scale production function, Cobb-Douglas, capital and human capital input. This epsilon is an exogenously growing technology term. Z is a shock to technology. Standard. Perfect competition leads to the standard first order conditions of the firm side. So returns to physical capital are marginal product minus depreciation, returns to human capital, marginal product of human capital. Okay.
That doesn't have a trend, right? That doesn't have a trend. It's just it doesn't have a deterministic component at all.
This is the deterministic component, but not Z itself, just here. Yeah, it's all over here. Yeah. Okay, and we do account for technology shocks in terms of Z, but also for depreciation shocks. This is what this asset pricing literature does often in order to match finally the standard deviation of stock returns in the data. Okay.
Does that ever drop below zero? If you're talking to sector stagnation, is there a return on physical capital?
Yeah, I mean, if there are cases, I mean, there are states in which the return on the return on physical capital might be negative. Yeah. Okay. In order to split up this return on assets into stocks and bonds, we set up an exogenous leverage of the firm. So there's a positive supply of bonds in this model. The capital stock, as I said, sets together from of bonds and stocks, where leverage ratio is held fixed in this model for all times and calibrated to the data. Stock return thus is the leverage return on physical assets minus leverage times the return on bonds. Okay, on the household side, we have a life cycle model, as I said. Households are born at the age of j equal to 0. They retire at a fixed age, j equal to jr, and die for sure when turning j plus 1 years old, capital J plus 1 years. survival probabilities before that are, as I said, age for sure, and also time dependent. So this is the demographic change, one part of the demographic change that comes into the model here. Initial endowments, positive fixed amount of human capital, no physical assets. So dynamic budget constraint then is that physical assets, so T is time, J is age. So tomorrow's physical assets, today's physical assets, time the interest, and the interest is risk-free return plus the share invested in risky assets times the equity premium, plus this is the earnings of the household, so human capital times the return to human capital, minus, and here the investment to human capital is here in financial terms, minus consumption. Okay, human capital accumulation, it's a linear technology. So tomorrow's human capital is today's human capital minus depreciation. This depreciation is age dependent, but it allows us to calibrate the model to a life cycle profile of earnings. Plus the idiosyncratic shock, so the risk, plus the investment, so this must be detrended, the investment into human capital. So this framework allows us to set up the household problem in terms of a single endogenous idiosyncratic state variable. We call this then, this is total wealth, W. Oh, here's something wrong, sorry. The brackets are missing. And set up cash on hand, following Deaton, so which is nothing else than total wealth, including the interest. So we can combine a budget constraint and end up with this this expression, where we have finally that tomorrow's cash on hand is what we save today, including the interest. Okay, and this is the portfolio return. So the portfolio return then sets together of the risk-free return plus the share in total wealth invested into stocks times the premium of investing into stocks over bonds plus the share invested into human capital times the premium invested of human capital over bonds. Okay. All right. So then the household solves, given the aggregate law of motion, his portfolio choice and savings consumption problem, and ends up with the two first order conditions for the optimal portfolio shares and the policy function for consumption. And importantly, as I said, all these do not depend on the idiosyncratic state variable, and this is very important. So the M and all these two conditions do not depend on X. So this is what keeps us computational tractability in this model of, as I said, demographic change in the NOLG model.
M doesn't depend on age?
No, it does. Sorry, this is just easy notation where the dash means next period's variables, meaning that depending on may depend on time and age. So M does depend on age for sure. Yeah. So this is finally the aggregate down here.
So but M is not. Is it the stochastic discount factor?
No, M is the marginal propensity to consume out of cash on hand that you have. Okay, and this is for sure also age dependent, because this is a certain. This is the framework that finally. This is also going back, I think, to Samuelson, a framework that enables us to write the budget constraint in terms of a single idiosyncratic state variable and to have consumption being linear in this cash on hand that you have.
So, and what's the utility of agents?
We do take here Epstein-Zinn utility. Finally, you can, which is standard in this asset pricing or in asset pricing literature. You can also write this down in terms of a CRA utility function of consumption.
This is just the result of the equation.
Yeah, exactly.
Substituting the budget constraint, going back to period 0, you get something like this.
For clarification, what is the idiosyncratic shock? I just didn't miss it in your last slide. What is the idiosyncratic shock these agents are facing?
The idiosyncratic shock is here to the human capital stock. So finally, this translates into a shock to the earnings, the idiosyncratic stock of the earnings of human capital earnings of the household. And this shock here I mean, we allow for counter-cyclical variance in this respect. Okay, so that the variance of this idiosyncratic shock is higher in downturns than in upturns.
And I is in units of what? Time?
No, it is.
Pecuniary.
It is pecuniary, exactly. So this is why this I is in here.
And when they die, what happens to their assets when they die, or they?
Here, accidental bequests are consumed by the government, so they're neutral in this respect. They're burned, you can say, in this kind of model as well.
Okay, but you will probably still run into the retirement savings puzzle then, right? That these guys will just want to decumulate assets when they retire, right?
Yeah.
So reality is, so they will help probably at higher ages. They will probably hold less wealth than in later, right?
So we don't have any bequests in this model. So they start with zero assets and they end up with zero assets, despite the fact that they survive. They don't survive until then. Okay. How much time do I have? Sorry.
18 minutes.
I didn't get it.
That's your answer. That's your answer to everybody. 18 minutes.
18? Okay. Okay. I see. All right. Let me come to the quantitative part. So, as I said in the beginning, we compute the entire transitional dynamics starting from 1960 to 2500. The demographic change evolves until 2100. It's kept fixed afterwards. So far, calibration period is really 2010, where we try to match profiles and aggregate data, moments from aggregate data. The major period of projection for us is then 2010-2050, in particular 2010-2030, because I think demographic forecasts in this period are better than we can say than for the future period. Okay, we use a variant of the Krusell-Smith, typical Krusell-Smith simulation, Monte Carlo simulation approach to solve the model. And we, as I said, we calibrate the model and try to match, in particular here, the equity premium in terms of 6.2%, capital output ratio, the return to bonds 1.3%, and the age earnings profile by calibrating the depreciation to human capital.
Can you say something quickly about why is it that you can match the equity premium?
Exactly. So, this is very, very difficult in this model. So there are several ways that we do it. First, we have a large risk aversion parameter in terms of 8.4, which is considerably large. I mean, some people say that's still okay until maybe a value of 10, but still it's comparably large. We do have this exogenous leverage in the model. This is one of the main parts. As I said, there's a leverage position. Where's the number here? So bonds over stocks, it's 2/3. So this leverages finally the risk from the total asset into into the stock. Yeah, exactly. This is very closely related to what they do. Yeah.
But so in these models, often you overestimate the portfolio shares of risky assets. Do you have a plot of that?
Yeah, I do. This is exactly the next plot that I have. So in terms of, this is the share, the cross-sectional profile in 2010 of the share of stocks in financial assets. And this is what we get. As I said, I mean, you were arguing that here in the beginning, the data says that there's something else going on. I mean, there's this Americans and Zeldis paper, which tried to analyze that, and they're saying, okay, in the 90s, I mean, before then we saw a hump shape, but in the 90s here moved up a little bit. So I can't really say that this is the case here for sure. I mean, this is a theoretical model in this respect. So this is what we have in this model, and this is the typical pattern that you see, this declining share-wise that, because you have, where do I have it here on the slide? Here we have this human capital wealth effect. So the human capital wealth in the beginning of the life cycle, so the prospective future earnings accumulated and added up for today, so the present value of that is very high in the beginning, and this is why finally, this is an implicit, the holding of that is rather an implicit holding of bonds than of stocks, and this is why in the beginning of the life cycle, households hold a large fraction in risky assets. This human wealth over the life cycle declines, so the household reshifts its financial portfolio towards bonds. And then we see at retirement there's this drop, because then suddenly the human wealth is gone at once, right? And this is why it also almost remains stable over time. This is then what comes from the literature, Merton Samuelson already. Okay, as I said, given that in 2030 there's a larger fraction of the population here at old ages than in 2010, we have this shift in the demand, in the relative demand for bonds, okay? And this is what finally then has these first order effects on the equity premium, and then leads to an increase in the equity premium in the first order. Okay.
I mean, if you look at US data though, about 60% of the stocks in the US are held by people 60 or older.
Yeah.
And if you look at people between ages 20 and 60, the share of assets in equity is like a quarter, right? So the actual figure looks quite a bit different than who holds the stock is very different than what you have here. Like if you look at say Potter about 2000 or Heaton and Lucas, they have all these graphs. They have the shares of wealth by different groups.
Yeah. I would say that much more. Sorry?
Participation is not shaped over the life cycle.
Yeah, I think this is, I mean...
Sure. So getting that is much harder here. So I assume here everybody is holding a stock. But if you look at unconditional shares, that's also slightly hump-shaped and actually tops out at 25-30%. Whereas here it starts at 120%. When in fact at that age most people don't hold any stocks in the US data. So
I mean, as I said, this American Zelda's paper says a little different, but...
No, I mean, in their data too, it doesn't look anything like this though.
No, and in the 90s, I mean, it shifts up over time. This is exactly, I mean, starting from the... No, I mean, for sure, yeah, you're right. I mean, it still remains under 100%, but still, like, flatter than this. But yeah, okay, I take your point. I mean, can't do anything about this in this respect, but participation is maybe one of the points at the end of the life cycle.
There's a nice paper by Russ Cooper and the co-author that's forthcoming in the red. You may want to look at that. They get all these things actually pretty. They have a few costs of trading, and then they get all these shares pretty well pinned down.
Bequests might solve that, right? Because maybe you hold the risky assets for your children. Anyway.
Yeah. Okay. Based on that, what I can show you is a preview on the aggregate dynamics and the wealth implications of that. So what I try to show you is that first in a baseline model, and secondly in a artificial model, as I said in the beginning in the preview on the results, where we hold we try to hold the measure of human capital fixed. Here in this model we can just hold the shares invested into of total wealth invested into human capital fixed over time. And this is what we do, okay? So we have an artificial auxiliary model where we hold these shares fixed, and the overall portfolio choice is then only between stocks and bonds anymore. And this is what we try to approximate a world where quality of labor, so the investment to human capital, does not majorly change. Okay, and yeah, exactly. So the left sub-figures are the one for the baseline economy. The right sub-figures are the one for the auxiliary economy with fixed human capital shares. What you see here is the blue line is the physical capital output ratio. The red line is the human capital output ratio. And we do observe here this first order effect that we expect. So a declining human capital to output ratio, increasing physical capital to output ratio. What we observe is that if human capital investments can adjust, and I said that there's an incentive for the households in an aging economy to invest more into human capital because future returns on human capital go up in expectation, then we see that this effect in the aggregate is quite strong. So we observe that the capital to output ratio goes up much stronger and the human capital to output ratio goes down much stronger. So we see that this human capital investment offsets a lot of the effects that come in because of the quantity of labor. So this is more or less purely the quantity of labor. Here we also account for the quality of labor, and we see that this is a strongly offsetting effect of the drop in the relative quantity of labor. Okay, we can go through all this again for the other variables. So here we have determinate output per capita, and we observe that in the baseline economy, by 2030 we see like a 2 percentage point, a 2% drop in output per capita, and an increase after that again by 2050. We see that the demographics bounce back a little bit in this period. So the strongest effect of demographics between 2010 and 2030 in the US. If we hold this human capital fixed, we see that these effects are much stronger, and we observe that by 2030 we observe something like a 5.5% drop in this output per capita. If you remember the simple calculus that I did in the beginning, then we had this where we keep fixed the human capital, where we keep fixed the physical over assets per capita, and there was a simple calculus saying that there might be something about 7.5% or something. We see that here if we try to exclude the adjustment of the human capital channel, but we still have in the model the adjustment of physical assets, physical capital, we see that this is pretty close to the number that we have, but a little less negative, meaning that there's physical capital substituting in for labor, for dropping the drop in the labor force. Okay, but we are not that far off of this simple calculus here. Okay, if we look at the capital return, so first the return to physical capital and return to human capital. I mean, this directly follows from the development of the capital output ratio, human capital output ratio, and we observe the increase in the return to human capital, the decrease in the return to physical capital. Okay, thank you. Decrease in the return to physical capital. But as we saw for the capital output ratio already, the effects are much stronger in case of holding fixed the human capital shares of households. So we see then here a drop of the left scale is for physical capital returns of the return to physical capital from 5 to about 4.2%. So like a 0.8 percentage point drop by 2030. So quite a strong drop. Okay, so what we do next is to split up this effect here on the on the physical asset return, the blue lines here, into risky and one period they had risk-free assets. We observe in the baseline model that both decline and almost at the same scale. This is what then finally boils down that the equity premium almost remains stable. That is what I showed you in the beginning already. I can show you in a second as well. We observed that the effects in general are much stronger, and that there's more to an effect to the equity premium. But I put this up here as a single side again. So this here is nothing else than the difference between the two lines, and we observe, as I said, in the baseline economy that there's almost no effect. So it's just a little effect on the equity premium. There are sizable effects if we hold the human capital fixed. As I said, there's an incentive to invest more into human capital in this aging economy. This makes this move to I forgot what I wanted to say.
Sorry, can I ask you a question?
Sorry.
Maybe I missed it, but did you show any match of the model with what happened before?
As I said, so far, I mean, I can show you more on the cross-sectional measures. Let me have a look. Finally, we try to match life cycle profiles. So what we do match is Hampshire consumption over the life cycle, with a peak at about 60, 55, something like this. In 2010, this is the case, so cross-sectional measures in 2010. Typical accumulation, decumulation of savings in these models. We do have a hump shape in stocks overall invested, not the shares, but the stocks. And yeah, this hump-shaped in human capital, which then translates into the hump-shaped in the earnings of the household.
It would be nice to see the patterns that you were showing us across time with what happened before, because we know the implied interest rates, we know the actual risk-free interest rate and everything, so we can kind of compare what happened with what the model implies.
What you can do with these models, you have to, if you fit them to the past, you have to feed in time variation and depreciation rates to be observing the data, and time variation and productivities. And if you do that, then they match quite well the trends in the capital output ratios that you observe in the data and some patterns of the returns. Okay. But we don't see in the past data these strong effects.
Okay, just a quick summary of what we saw. So here again, so these are the absolute values in percent of risk-free, risky asset returns and the average return to human capital, the equity premium. Here we observe the change in the baseline model. This is finally the numbers that I showed you in the beginning. Here, if we hold these human capital shares constant, we observe that this effect on the asset returns is much stronger if we hold the human capital shares constant. And also there's an increasing effect on the equity premium in that case. But the increased human capital investment into lead then to a stronger human wealth effect at the beginning of the life cycle. So this risky portfolio share and financial assets, this life cycle profile moves up, meaning that young people have more incentive to invest into risky assets, and this leads to a high demand for risky assets and yeah, leading to that figure. Okay, welfare consequences of that. We take two situations of the world. So first the baseline one. Okay, thank you. The baseline one and the second an auxiliary world. In this auxiliary world, we hold the population distribution of 1966. I mean, this is our approximation of what happens if, or what happened if there were no demographic change. And we do take an ex-ante welfare measure, so consumption equivalent variation. We compute in the lifetime utility, the expected lifetime utility of a household born in period T in the baseline economy and in this auxiliary economy, and compute the consumption equivalent variation from that. Okay, so finally, how do we compute this? By Monte Carlo simulations again. What we can observe is on the left hand side again the baseline economy, on the right hand side again the economy with holding artificially fixed human capital shares at the initial level. Then we observe that in general welfare losses for older generations. Main point here is that asset returns decrease, in particular the return to the risk-free assets. So, and at the same time human capital returns in the future increase, and old generations born, here we do have that until 2005, turning 20 until 2005, they don't benefit that much anymore from rising returns to human capital in the future, because they are then already retired and already retired. So for future generations, this is the other way around. The opportunity cost to invest into human capital, so the physical asset returns decline, and at the same time the human capital returns increase. Okay. All right, we see that the effects are stronger in the case of fixed human capital shares. Just to wrap up, we see that this aging does induce a reduction of output and also of asset returns. So there is a point in terms of the secular stagnation debate. We see that the quantity of labor decreases, and this is this drives mainly this point. However, the human capital adjustments mitigate those effects largely, and this is the main point that we have. So if you look at this in particular, we see that the differences in output and return effects are quite strong, that we do have a significant welfare effects of up to 1 percentage point in terms of consumption equivalent variation. Particular old generations lose, future generations gain, and in between. I mean, there's a transition to that. Next steps that we want to look at are to introduce a social security system here in this model, and then to address these issues with increasing retirement age in the future. In particular, also to look at what happens if we deviate from the Cobb-Douglas case and look at the SAS production function, where there's elasticity of substitution between physical capital and human capital might exceed 1, as Piketty also claims, right? Okay, thank you very much.
Yeah. Wait, my question was the first part. So the results can change if the young guy has to pay the taxes for the pensions of the old one, which is kind of an important effect.
Yeah, it's very important to that. This is what we actually working on at the moment to introduce that. Yeah.